Welcome everyone to our Week 2 live chat for FIN4501 Investments. I'm Dr. Mark Dennis, your instructor for this course, of course. This time we're diving deeper into the core concepts of investment decision making. Let's explore what risk and return really mean and why those things matter. The theme for this session is risk and return. We're going to explore how we quantify risk, how it interacts with return expectations, and how investors navigate this relationship when constructing an investment portfolio. Let's begin with the classic normal distribution. In this example, the expected return, E sub r, is 10%, and the standard deviation is 20%. When a distribution is symmetrical, the average equals the median, which makes standard deviation a practical measure of risk, even though most investors only care about the downside risk. In a symmetric world, the deviations above and below the mean are equally likely. That's why we can still use the Greek letter sigma to compare securities, even though more advanced metrics like downside deviation exist. Here we introduce two cornerstone concepts, the risk premium and risk aversion. The risk-free rate is the return an investor can get with zero uncertainty, typically represented by government treasury bills or simply T-bills. The risk premium is the amount above that return an investor would demand for taking on additional investment risk. So if a stock has an expected return of 9% and the risk-free rate is 3%, then the risk premium for that stock is the difference, 9 minus 3, or 6%. Keep in mind, some investors are more risk-averse than others, and the only way to encourage those investors to accept higher levels of risk is to offer a higher risk premium. Past performance doesn't guarantee future results, but it does teach us quite a bit about volatility and asset class behavior. Let's take a closer look at some actual data. This is the famous periodic table of investment returns published each year by Callan. It looks like chaos at first glance, and that's precisely the point. Each color block represents a different asset class, and each column shows its ranking by performance in a given year. What you'll notice immediately is that no single asset class consistently stays at the top or the bottom. One year, emerging market stocks might lead the pack, only to fall to the bottom the following year. This randomness is a powerful visual argument in favor of asset allocation. Since we can't reliably predict which asset class will be the best performer next year or even next month, diversifying across multiple asset classes helps reduce the overall volatility of an investment portfolio. You're essentially spreading your risk across the winners and the losers rather than gambling on a single outcome. Asset allocation is not about avoiding risk altogether. It's about managing it intelligently. A well-diversified portfolio can smooth out the highs and the lows, helping investors stay the course during turbulent markets. And that, over time, improves the odds of achieving long-term investment goals without getting whiplash from year-to-year market shifts. Inflation and real rates of return. Inflation eats away at the purchasing power of investment returns. It is important to remember that the nominal return you see does not tell the whole story. You may think you're earning 6%, but once you adjust for inflation, the real return is often much lower. This is why understanding the difference between nominal and real returns is so important in long-term investment planning. This example drives the point home with numbers. From 1966 until 2005, inflation averaged 4.29%. If you had invested $1 in T-bills in 1966, it would grow to $10.08 nominally, but only $1.63 in real returns. And remember, you pay taxes on the nominal return. So if you're earning 6% and you fall into the 15% tax bracket and inflation is 4.29%, your real after-tax return is a whopping 0.81%. It's a sobering reality. Here we look at the interactions among inflation, nominal rates, and real rates of return. The nominal rate includes compensation for inflation plus the real return. If expected inflation increases, nominal rates must also increase to keep the real return constant. This is a key concept for understanding bonds, monetary policy, and investor behavior. Asset allocation across risky and risk-free portfolios. When you build an investment portfolio, one of the first decisions is how much to invest in risky assets versus safer options like treasury bills. This decision influences not just your expected return, but also your overall volatility. Consider this simple case. You have $10,000. You place $2,500 of those $10,000 into risk-free treasury bills and the remaining $7,500 in a risky portfolio of stocks. That risky portfolio, consisting of stocks, might be further divided, let's say $3,000 in stock A, $2,500 in stock B, and the remaining $2,000 in stock C. This mix gives you a starting point for calculating portfolio weights and assessing your exposure to risk. Here we break it down. What portion of the risky portfolio is in each stock? Stock A is 33.33%, B is 40%, and C is 26.67%. Then we adjust those weights for the entire portfolio. Since 75% is in the risky portfolio and 25% in T-bills, stock A ends up being 25% of the complete portfolio. Stock B makes up 30%, and stock C is 20% of the whole. These calculations are essential when you're estimating portfolio return and risk. Let's shift gears and take a look at passive investing. The capital market line shows us the best possible combinations of risk and return, assuming a risk-free asset and a market portfolio. It's the foundation of modern portfolio theory and assumes that all investors can borrow or lend at the risk-free rate. Passive strategies ride this line. using diversified index funds and treasury bills to manage risk preferences. So which approach is better, active or passive? Active investing attempts to beat the market, but it involves higher trading costs and greater effort. Passive investors aim to match the market. In today's efficient markets, many investors choose the passive route, using index funds and adjusting their mix of T-bills and equities based on their personal risk tolerance. Time for a quick practice problem. Here's a scenario with 4 possible outcomes. You simply multiply each return by its probability and then add them up to find the expected return. This approach is foundational in investment analysis, and it helps you compare opportunities based on expected value. That's a wrap for part 1 of our week 2 session. Please take some time to review the slides and practice those return calculations. If you have any questions, drop me an email, or you can always text or call. I'll be back with part 2 soon. See you online.